This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade FOREX Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here wrapping up the week. Today is February 1st, 2008. We're officially 1 month into 2008, and so far things are looking pretty rough in the U.S. Stocks and the dollar are under pressure as data continue to point towards slow growth this year. Even a heavy-handed Fed hasn't been able to boost confidence enough to impede stock declines. Today's jobs number was the first negative non-farm payrolls figure in more than 4 years. Thankfully, it was coupled with an unexpected decline in the unemployment rate and followed by an upside surprise in ISM manufacturing. This helped us to avoid a potential bloodbath in the final session of the week. Action in the majors today was more divided than we have seen in a very long time. We saw a strong push higher in the dollar against the European currencies, but commodity currencies wouldn't give in. The yen, meanwhile, appears to be unchanged today after a wild week of ups and downs. As we have noted frequently in recent months, there are a number of themes in the market these days that seem to rotate on a regular basis. What is the holy grail one day can be ignored the very next as traders switch focus. One thing we can be sure is that uncertainty here has without warning. Traders must therefore remain patient consistently. Now to the big picture. We thought the big picture couldn't get any worse for the dollar. It stages an end-of-week rally. Who would have guessed that the first decline in non-farm payrolls since 2003 would give the greenback a boost against several major currencies, including the euro? We certainly didn't. In fact, 6 hours ago it looked more likely that 150 would finally be achieved. After all, another ECB official just said today that inflation is a major concern in the eurozone after it jumped to 2.2% in a report published yesterday. Meanwhile, it looks like rates will continue to spiral lower in the U.S. We can try to rationalize the move by pointing towards risk aversion and a decline in carry trades, but the buck's strength still seems unwarranted. On the other hand, Morgan Stanley's head of global currency strategy, Stephen Jen, says the dollar performs better when the U.S. economy is growing slowly or even contracting. He expects the dollar will gain 10% on the euro by December. That's about 15 cents or 1,500 pips. Or perhaps it is a new school of thought in the Forex. Could traders finally be coming to the realization that elevated inflation forcing the ECB to keep rates high in a slowing economy is not a good thing? Whatever the reason, the euro dollar is setting the stage for a move lower in the short term, and it's not alone. The pound sterling and franc may also be vulnerable. The Aussie dollar and Kiwi are trying to keep upside momentum going, but could be faced with a situation similar to the eurozone, slowing growth coupled with rising inflation. These currencies are both at key resistance levels today on daily and weekly charts. This reinforces how important it is to keep an open mind in these chaotic and unpredictable times. Till next week, enjoy your weekend. Take care.